Welcome to today's Explainer, where we're going to unpack one of the absolute largest real estate transactions in Canada this year. I'm talking about the massive, highly strategic breakup of H&R REIT. You know, this really isn't your standard run-of-the-mill corporate takeover. It's a fundamental restructuring, and it's sending a huge, flashing signal about exactly where the smart money is moving in North American real estate right now. If you want to understand the modern private equity playbook, you are absolutely in the right place.
Okay, let's dive into this. Here is our roadmap for today. 1. The billion-dollar breakup. 2. Breaking down the valuation. 3. Who buys what? 4. Institutions versus retail. 5. Risks and headwinds. And 6. Key takeaways.
Section 1. The billion-dollar breakup.
6.7 billion Canadian dollars. Let that sink in for a second. That is the massive headline enterprise value of this deal. And yes, that includes debt. Basically, H&R REIT, which happens to be one of Canada's oldest and largest diversified real estate investment trusts, has agreed to sell off its entire asset portfolio. And the buyer scooping it all up? It's a consortium led by GO Residential REIT and the private equity giant Blackstone. But here's the thing. The actual structure of this massive sale is where things get really fascinating.
See, this isn't just a simple take the cash and walk away kind of buyout. Honestly, think of it more like a massive corporate divorce where the parties are still deciding to keep joint custody of their absolute best assets. The current unit holders are cashing out a bit, sure, but they are also keeping some serious skin in the game. Post-deal, H&R unit holders will actually retain a massive 67% ownership stake in the newly combined GO Residential REIT. They're staying incredibly invested in the future upside of this whole newly structured entity.
Section 2. Breaking down the valuation.
Let's get right into the numbers. The pure equity value of this deal sits at 3.4 billion Canadian dollars. So if you happen to hold H&R units right now, here's exactly what lands in your pocket. $4.28 in cash plus 0.5688 GO REIT units for every share you own. Now, why use this specific kind of quirky structure? Well, the cash component is essentially designed to cover any taxable elements like income and capital gains. But that fractional GO REIT share, that's the magic trick. It allows Canadian residents to essentially keep the taxman at bay through a rollover deferral. It is a highly tax-efficient structure, meticulously tailored for long-term holders. Now, what's really interesting about this slide is how it exposes the classic private equity playbook. Before rumors of this deal started circulating back in June, these units were trading at roughly a 21% discount to their fair value. This new deal bumps that up to a guaranteed $12.01 per unit. That's a 14.5% premium over that pre-deal trading price. But here's the catch. What is the true intrinsic value? Well, third-party analysts actually peg that closer to $13.10 per unit. So while Blackstone and GO Residential are definitely closing most of that gap, they are still buying at a noticeable discount to what these assets are intrinsically worth. Like I said, buy when public markets are discounting and sell when they re-rate.
Section 3. Who buys what?
To pull this off, the transaction is essentially split into two very distinct tracks. Track 1 is GO Residential REIT, and they are taking 27 major U.S. residential properties. That is an astounding 10,300 suites spread across the New York City metro area and those really high-growth Sunbelt markets like Florida, Texas, and Arizona. Just this residential portfolio alone is valued at roughly $2.8 billion. Then we have Track 2. This is the Blackstone-led consortium, and they are buying up H&R's Canadian industrial properties and some non-core assets in a straight, all-cash deal. This right here is pure specialization in action. GO Residential gets to double down on its deep expertise in U.S. housing, while Blackstone just sweeps up the industrial assets it has been aggressively targeting all across North America.
Section 4. Institutions versus retail investors. If you zoom out and look at the market over the past 18 months or so, retail investors and large institutions have basically been living in two entirely different realities. Retail investors, they've been net sellers. They're totally spooked by higher interest rates, making debt more expensive, persistent inflation eating into operating margins, and a temporary dip in immigration reducing demand. They are rotating out of real estate out of fear. But institutions, we're talking giant pension funds and private equity, they are net buyers. They're looking right past this current softness, spotting a cyclical bottom, and enthusiastically stepping in to buy. So, why exactly are these institutions so hungry for residential real estate right now, despite all the negative public sentiment? It boils down to three main factors. First off, construction starts are declining pretty significantly, which is strictly tightening up future supply. Less supply means higher value for existing assets. Second,
Population growth is fully expected to rebound by 2027 and beyond, both in Canada and down in the U.S. Sunbelt. And third, rental housing is fundamentally a defensive asset class. Look, regardless of the economic cycle, people literally always need a place to live.
And this brilliantly illustrates that the H&R transaction is absolutely not an isolated anomaly. It's really just the latest domino to fall in a massive sweeping trend of private capital capitalizing on public market discounts. Think back to Blackstone's 2018 acquisition of Pure Industrial REIT when warehouses were totally out of favor. They rode that to massive profits. We've also recently seen huge take-privates with Minto Apartment REIT at $3.3 billion, InterRent REIT at $2 billion, and First Capital REIT for $5.2 billion. In H&R's specific case, an activist hedge fund called K2 & Associates basically forced the issue. They pressed hard for a sale simply because the public market discount was just too massive to ignore anymore.
Section 5. Risks and headwinds. Now, we have to be balanced here because this isn't a guaranteed home run just yet. The buyers are stepping into some real macroeconomic crosshairs. First, the broader U.S. housing market is currently facing headwinds from weak consumer sentiment, persistent inflation, and those elevated interest rates. If the economy softens even further, rental growth could absolutely slow down. On top of that, GO Residential is taking on a very significant debt load to pull this off. If rates stay high, refinancing that debt is going to severely pressure their cash flows. And finally, the deal is not actually finalized. It requires a 66 2/3% approval from existing H&R unit holders. That is a very high hurdle, particularly because a lot of folks might rightfully argue that $12.01 is still leaving far too much intrinsic value on the table.
Management, of course, is quick to counter those risks with a very compelling upside case. They're projecting a solid improvement in funds from operations, or FFO, per unit. They're arguing that this post-transaction combined entity will have a much stronger balance sheet and an overall better credit profile. Plus, by creating this massive pure-play residential REIT, it dramatically increases their potential to be included in major market indexes down the road. And index inclusion, that passively draws in massive waves of institutional capital, which provides greatly enhanced trading liquidity for everyone involved.
Section 6. Key takeaways.
So the crucial point is really a synthesis of three distinct lessons here. Number one, this $6.7 billion transaction is a massive vote of confidence by smart money that residential real estate is fundamentally undervalued in the public markets today. Number two, this unique hybrid structure guarantees existing unit holders a 67% upside participation in GO Residential's future, keeping them tied to that future growth. And number three, institutional capital will relentlessly and consistently exploit fear-driven public market sell-offs to buy up hard assets at a steep discount.
Which leaves us with this final, somewhat provocative thought to ponder. Will the public markets finally start accurately pricing in the true intrinsic value of real estate, or is the private equity smart money just right once again, scooping up incredible assets at a massive discount? I mean, looking at the H&R breakup, it clearly shows us who is currently winning that tug of war. Thank you so much for joining me in this explainer today, and keep your eyes on the markets.